Hello everyone, and welcome. Today we're diving into one of the core concepts in ICT trading, fair value gaps and imbalances. This is where we start to see the market not as a random walk, but as a series of inefficiencies that smart money leaves behind, and that we can learn to trade. Let's start with a fundamental idea: markets are not always efficient. Sometimes, price moves so quickly that it literally skips over price levels. This creates an inefficiency, a zone where orders were left unfilled. It's like the market left some business unfinished, and it often has to come back to finish it. We can think of price action as either efficient or inefficient. Efficient price is balanced, with equal buying and selling. Inefficient price is characterized by a strong, impulsive move, what we call displacement. This displacement is what creates a fair value gap, or FVG. An FVG is a specific zone on the chart where price moved so fast between two candles that it left a gap with very little trading activity. It's a vacuum, and like nature, the market abhors a vacuum. It often feels a magnetic pull to come back and fill that gap later. The classic FVG is a three-candle pattern. Candle 1, the initial impulse move that starts the momentum. Candle 2, this is the key candle. It's a large-bodied candle that creates the gap between the wicks of Candle 1 and Candle 3. Candle 3, this candle continues the move, solidifying the gap between them. That space between the wicks of Candle 1 and 3 is your fair value gap. So how do they form? Through massive institutional order flow. A big bank executes a huge order, displacing price instantly and leaving this inefficiency behind. These gaps become fantastic potential areas for us to enter trades. In a bullish FVG, price gaps up. The FVG zone forms below, between the wicks. We often see price return to this zone later to fill the gap before continuing the uptrend. The opposite is true for a bearish FVG. Price gaps down, leaving the FVG above. We then wait for price to retrace back into that zone before resuming its drop. Now, here's a crucial twist: the inverted fair value gap, or IFVG. This is when price doesn't respect the FVG as a level to be filled. Instead, it smashes right through it. Think of it as the market saying, that old inefficiency doesn't matter anymore, the momentum is too strong. An IFVG is a powerful continuation signal. It often forms during very strong trends and indicates that the institutional order flow is not done yet. It's important to understand the relationship here. An imbalance is the broader term for any zone of inefficient price delivery. A fair value gap is a specific, clearly defined type of imbalance. So, all FVGs are imbalances, but not all imbalances are clean, three-candle FVGs. The core mechanic here is rebalancing. Price is drawn back to these imbalance zones to restore fair value and collect the liquidity that was left behind. Once that rebalancing is complete, the original trend often resumes. This makes FVGs incredible trading tools. We use them to identify high-probability retracement zones for entries, to spot where the big players were active, and to place our stop losses at either the last swing point or the high or low of the first candle. But you should never trade an FVG in isolation. Its true power comes from confluence. Does the FVG align with a key liquidity pool? Is it sitting right on an order block? Does it form during a key session time like the London or New York Open? The more these ICT concepts line up, the higher the probability of your trade. Which brings us to risk management. Not every FVG will fill immediately. Some might take time, others might not fill at all if an IFVG forms. So, never chase price into an FVG. Always wait for price action confirmation, a bullish or bearish candle closing within the zone. And always place your stop loss on the other side of the inefficiency. Common mistakes include treating every gap as a sure thing, ignoring the broader market structure, and overtrading in choppy markets where FVGs are less reliable. To conclude, the key takeaways are powerful. Fair value gaps highlight the institutional footprint, the inefficiencies they create. Price is magnetically drawn to fill them, unless we see an inverted fair value gap signaling strong continuation. Always combine fair value gaps with other elements of market structure and liquidity. And finally, be patient, wait for confirmation, and manage your risk. Mastering this will change how you see every chart. Thank you for your time, and I'll see you in the next lesson.